Good evening, members. I, CA Nidhi Singh, Secretary of the Center for Audit Quality Directorate, am very delighted to welcome you all to the 20th Quality Cafe session on practical aspects relating to audit trail reporting organized by the Center for Audit Quality Directorate. Today we have with us CA Vishal Doshi ji, Convener of CAQ, and CA Pramod Jain ji, Deputy Convener of CAQ. Very eminent speakers and panelists, past President CA Manoj Fadnis sir, CA Deepa Agarwal, and CA Kedar Savle. The session will be moderated by CA Aditya Kumar and CA Ashish Gupta. Vishal sir, I would invite you to deliver your welcome address.
Thank you very much, madam, and a very, very good afternoon to all our participants who have joined this Quality Cafe session on Audit Trail. I also take this opportunity to welcome the Deputy Convener, CA Pramod Jain ji, our panelists in absentia who will be joining shortly, our respected past President, Sir, CA Manoj Fadnis ji, CA Deepa Agarwal ji, CA Kedar Savle ji, and the moderators, CA Aditya ji and CA Ashish Gupta ji. Well, friends, I think I did not stress much on the importance of audit trail and the reason for having this webinar because I understand across the country, all professionals are definitely getting geared up for this mandatory reporting of audit trail, which is, I would say, made applicable from this 31st March 2024 audit report. At the CAQ, we undertake a lot of activities of supporting our members in respect of improving their audit quality. And definitely we have come out with different tools and utilities on engagement letter, on materiality, also on compliance with respect to the standards on audit. And let me tell you, friends, these are all routine Excel tools, which are very easy to use in the day-to-day practice by ourselves as well as our team members. And we have also come out with various publications which would help the compliance with respect to SQC1 at the firm level. So we've come out with a model firm referencer, which would help the firms in drafting certain firm level policies and procedures. We do a lot of other activities also, but coming to the topic on the audit trail, like I said, that it's been mandatory with effect for reporting from 31st of March 2024. And from the Institute of Chartered Accountants of India, from the AASB, the Auditing and Assurance Standard Board, we have come out with an implementation guide. So the first, I would say the original version was released last year in the month of March, April 2023. And thereafter, we had circulated. I'm sharing these insights because I also happen to be the vice chairman of the AASB. So we had then circulated a form requesting for further queries or questions that members might have in implementing, either on the preparer side or I would say the implementation side by the companies or from the auditor side on the reporting. And we received a lot of questions which were deliberated, and I'm happy to share that Deepaji was also part of the group which was working on this implementation guide. And recently we have, I would say in January, we have come out with the 2024 edition of the implementation guide, which has 25 FAQs attached to it, I would say, along with it. And these are something which are very useful, very practical. And considering that the audit season has just started, and members are also now on the verge of implementing, or I would say reporting, the various aspects of audit trail, we thought at the CAQ pertinent that let us have a webinar. And instead of a presentation, we thought let us have it in the form of a panel discussion. And that is what we always have under the Quality Cafe series, that we do a panel discussion. We have an interactive session with our esteemed learned panelists. And we would also request you as participants that wherever you have any questions, you can put them in the chat box. And we would request our moderators to also ask those questions to our panelists so that your questions would get resolved. But I am pretty confident that with the expertise that we have today in the panelists, at the end of 2 hours you should not have much of questions, additional questions to ask on the audit trail. So with this, once again, I welcome you all to this session. And I would at this point also thank Nidhi Madam, the secretary, who has worked very hard in, I would say, stitching together this Quality Cafe session. And I wish you all a very, very happy and fruitful learning. Thank you. Thank you very much.
Thank you, Vishal sir. Moving on to the next session, before I hand over the proceedings to our panelists, I would like to read a brief profile of our panelist, CA Manoj Fadnis sir, who will join us shortly. He is a past president of ICI. He is also the past president of CAPA, a regional international organization of 32 professional institutes from 23 countries from Asia Pacific region. Presently, he is independent director on the board of Federal Bank and serves as the chairman of the audit committee. He is also on the board of other companies. He was nominated as a member of the Standing Committee on Accounting Issues constituted by the IRDA. He holds a diploma in Information System Audit and has specialized in corporate accounting, reporting standards and direct access, corporate laws, and Foreign Exchange Management Act. He has presented more than 1,000 technical papers in seminars and conferences within India and internationally. CA Deepa Agarwal. CA Deepa Agarwal has almost 22 years of experience in serving national and multinational companies in the areas of auditing and accounting, corporate laws, and other related matters. She has completed CPA Australia. She holds a diploma in Information System Audit and certificate in IFRS. She has worked with various committees of ICAI, including the Technical Directorate, AASB, and Corporate Laws and Corporate Governance Committee. She has assisted ICAI in various publications, such as the Implementation Guide on Audit Trail, Auditing Standards, Checklists, Working Paper Templates, Guidance Note on CARO, Background Material on AS16. She has been working with renowned consultancy firms since almost 16 years. And currently, she is working as a partner with SR Bartley Boy & Co. CA Kedar Savla. He is a partner with Deloitte's advisory practice and has more than 24 years of post-qualification experience. He is also a certified information system auditor, forthright and highly versatile executive with proven ability to strategize and turn around challenging scenarios and implementing strategic initiatives across organizations. Over the years, Kedar has also focused on gaining assurance on new technology solutions available in the industry like bots, Gen AI, along with the others. His relevant experience includes understanding processes, applicable accounting principles, guidances prescribed by the relevant regulatory authority, and evaluating how the same have been complied with through the use of technology solutions deployed in an organization. In the past, Kedar has been a facilitator at the Institute of Chartered Accountants, Institute of Internal Auditors, and Wellinkers Institute of Management Studies, Mumbai. Then we have our moderator, C. Aditya Kumar, who specializes in accounting standards and other financial reporting aspects. He has undertaken statutory audits, limited reviews, internal audit of companies in various industries, including banks, mutual funds, etc. He advises on Ind AS, IFRS, multiple gap to Ind AS, including transition, implementation, training, and regular updates and implementation. CA Ashish Gupta. He is an experienced and diligent CA with a proven track record of delivering high-quality financial expertise and he is proficient in financial reporting, tax planning, auditing, and risk assessment. Detail-oriented and analytical problem solver, Ashish is adept at identifying opportunities for process improvement and cost optimization. He possesses strong communication skills and commitment to maintaining the highest ethical standards in all professional endeavors. Now, Vishal sir, I would request you to give an opportunity to the panelists to present their opening remarks.
Yeah, sure. Thank you, madam. Before I come to the panelists, I would request Pramod Bhai, who is the deputy convener and I would say my guiding force at the CAQD, to please give his opening remarks.
Thank you very much, Vishal sir, the convener of this very, very important directorate, the Center for Audit Quality. And in fact, kudos to you and the team for organizing such a very, very important session today. And I also, along with you, welcome our panelists today. In absentia, CA Manoj Patnes ji, our past president, who must be joining within a few seconds. I'm currently in his city itself, Indore. So initially, we had thought that we will be joining together and will be together at Indore branch doing that, but immediately he had certain work, so he could not come to the branch. So he'll be doing it from his office. So he will be joining very shortly. Kedarji, Deepaji, the other two panelists, and of course, along with them, the two very vibrant moderators, Aditya ji and Ashish Gupta ji from Amritsar. And of course, the topic, there have been various sessions on audit trail, and most of the sessions initially they talk upon what is audit trail, what is the provision under the Companies Act, what is to be done. But the purpose of the Center for Audit Quality is to improve the quality of the audit. And keeping that in mind, this quality cafe session is focusing purely upon the practical aspects for audit trail reporting. So reporting on the financial statements audit report. In that audit report, not only Rule 11 UG the other sections of the 143 of the Companies Act and the whole audit report, even IFCOR. So all those things would be discussed in the practical way, and that would be very useful for the auditors, that what to look for, how to report, and in what case what to report. So this way, this session would be very, very useful, and I'm very sure that this session after this discussion would be made available future for the future reference also on the ICI TV. It would also always be there, and also on the CAQ Directorate page, the link would be there. So hoping all the participants, thank you for joining, which are already very good in number, for having a very fruitful session today. Thank you. Thank you very much, Vishal bhai.
Thank you, Pramod bhai. So we'll straight away now jump to our panel discussion. So what we'll do is we'll have opening remarks from the panelists, and then I would request the moderators that they can deep dive into the session with the questions and answers with the panelists. And in the meanwhile, like I said, that for the participants, if they have any question, they can feel free to type in the chat box, in the question box, and Nidhi ji and the team would be more than happy to share them with us. So starting with Deepa ji. Deepa ji, we are all aware that the changes were made to the company's accounts rule and the audit and auditors rules. So accounts rule typically would mean the responsibility of the management with respect to the audit trail. So we would request you, because there are a lot of participants who would be from the preparer side, or I would say the management side also. So what is the management's responsibility to ensure compliance with the audit trail requirements? And in your view, where do you feel are the challenges that may arise in its implementation?
Yeah. Thank you, Vishalji, and thank you, Pramodji. I think you have set the context, and thanks for giving this opportunity yet again with the CAQ. So I'll straight away first come to the questions. And as Pramodji rightly mentioned, that this is something now we want to talk about the practical implementation, because it is already applicable from April 2023. And Vishalji, thanks for raising this very pertinent question. I think it's not just for the preparers, but also for the auditors to know that this is something, the responsibility of the management first, and then comes the role of the auditor. So I really want to highlight this, that both goes hand in hand. But first, the management has to make sure that there is a provision of the audit trail, and before the auditor can report. So the MCA amended the accounts rule in 2021, and they actually deferred it twice because there were a lot of representations made by the companies. And finally, it became applicable for accounting periods or the financial year beginning on or after April 23. And the requirement is, as you all of you know, that the books of account. And when I say books of account, you already have a definition in Companies Act 2013 in section 2, subsection 13, which defines what a books of account. account. So the requirement is that the books of account should use only such accounting software which has a feature of recording audit trail of each and every transaction. So one has to keep in mind, one, the applicability, the books of account maintained in electronic mode. And if yes, then the company has to ensure that the accounting software has a feature of recording audit trail of each and every transaction which is impacting books of account, and creating an edit log of each change made in the books of account, along with the date when the changes were made, and ensuring that the audit trail cannot be disabled. So, which means management will have to think about, or would have already thought about. Now it's too late for me to say that, to think about, because it's the first year of reporting now. So the audit trail should have the feature in the software, and it cannot be disabled. And this requirement is applicable from 1st April 23, which means the auditor will have to consider the entire year. The auditor will have to report on the fact that the audit trail was implemented throughout the year. So management has a responsibility to ensure that, first of all, the software has been identified, which are the accounting software which have been used for maintaining the books of account. So I think identification of accounting software, the first step for the management. And second is to make sure that the audit trail feature is there. And if they believe there is some software which there is no audit trail, then they should be upfront about it and discuss in the sense, now which are those accounting software which does not have an audit trail. So and to how to demonstrate, I think the company will have to keep in mind that there should be specific internal control, predominantly IT control, which in turn would be evaluated by the auditors as appropriate. So the auditors do the ITGC testing, but this is something over and above what has to be done by the auditors. Another important thing which I want to mention here is one needs to keep in mind that there is a penalty provision also in section 128 of the Companies Act 128(6). Now, the reason why I'm highlighting is because I have heard many people telling me, I'm talking about preparers, that they're not aware of any penalty. So there is a penalty for any non-compliance with any provision of section 128, which includes your books of account. And the penalty is on if the managing director, whole-time director, CFO, or any other person of the company who has been given the responsibility for complying with this requirement, then there is a penalty which shall not be less than 50,000 and which may extend to 5 lakh rupees. So if there is any non-compliance, please make sure that you are aware about this requirement. And the third thing which I want to mention is that it will be a good practice if a note is included. So when we are saying that it's a management responsibility is there, then probably the management may also evaluate giving a note about how it has complied, what is the non-compliance or anything. So I think this is something which can be evaluated of giving the management note, and this would actually help, because otherwise auditor will end up reporting everything. So auditor may give details of the software, and we have very good examples in the implementation guide. However, the management can also give the detailed note in terms of complying with the responsibility in the accounts rule. So that is something on the management responsibility. Now, covering few of the challenges, as Vishalji mentioned, that, what are the challenges which you are seeing practically. So one is it is applicable to all the companies. And I think, this is something, there is no exemption, which means small company, mid-sized company, section head company. Therefore, this is something a cost for the companies in my view, because they will have to make sure that they have the software which has the audit trail. And this will also require some upgrades and, hardware and security system, and then the backup of the audit trail. So definitely it is increasing a cost for the companies. That is one thing which I'm hearing and looking at the challenge. And second is the identification of books of account. Still, a lot of questions are raised. What is books of account? Can I say my purchase order, my sales order, my legal agreements are part of books of account? So I think you will have to go back to the original definition of what is there in section 2 subsection 13. Every underlying voucher or the paper, and you have to read it with the definition there, that what are my books of account and which are, for which the accounting software, is used to maintain the books of account. And the definition is very wider. I think that is something what needs to be very clearly determined. What are my books of account? And third, as I mentioned, is on the identification of the software. So the management has the primary responsibility for ensuring that the software for use for maintaining books of account comply with the requirements, even though the software is owned or licensed by some other entity. And there will be many companies, which may operate as part of international chains. So for example, a company is in the business of hotels run by an international chain and generally use robust software created for room revenues, food and beverage, and which are tested centrally. Now, in such cases, local companies which owns the hotel may not be permitted to make any changes to these software, and the extent of data visibility at the backend in terms of trail, etc., may be visible only centrally at the parent level of these operating international change. So therefore, in such cases, there may be difficulty for the local companies to get access to such data. So I think these are some of the challenges, and whenever we implement, we do have some practical challenges. It takes some time, the transition phase, to get to the final this thing, and then I think probably we'll be in a better position. So that's all from my side on management responsibility. Thank you.
Thank you, Deepaji. I think you made a very pertinent point that first, it is the responsibility of the management, like we have for the preparation of financial statements, that it is the management's responsibility. And then as an auditor, we have a responsibility to review that and give our opinion on it. I think similarly on the audit trail also, that first it is the responsibility of the management to have such an accounting software where audit trail is enabled and which cannot be tampered with. And then as an auditor, we have got our reporting responsibilities on that. I think so that is very important. And also on the penal provisions, which are included, because many times, during our interactions, when we visit various branches and interact with members, there is always a question that, what is the penalty if the company, because many times, in many cases, it has been observed by the auditors that the company may not have the audit trail in place, and therefore the question that the auditor asks is what is the penalty on the company. I think so that has been very clearly responded by you. Kedarji, for you, you are a man of technology, and I think for the participants, thank you, Deepaji, for recommending Kedarji's name, because we thought that audit trail being a IT, so not income tax, but an information technology subject, we thought that it would be good to have a panelist who can understands definitely and can explain also to our participants on the technology front. So, Kedarji, how does a company gear up for the purpose of audit trail reporting in terms of the identification of the software, and what type of softwares are being used by the companies? If you can throw some light on that.
Sure. Thank you, Vishalji. Thank you, Pramodji, and thank you, Aditya, Ashish, also for moderating this session. Deepaji, thank you very much for all your. I think you've already initiated the answer by accounts, because that is one of the most critical elements when we are looking at how do you identify and what exactly do you enable the trail. I think that is extremely important as part of this exercise, and I would say, as a first step, every single management, every single organization, what they need to start doing is identify each and every single accounting entry that is getting posted or accounted for in their environment, in their system, in their different lines of businesses. Because again, here you cannot apply the principle of materiality. It will have to go on a 100% basis. So you need to literally go threadbare, identify each and every single transaction, be it a master data or an transaction that is getting posted in the environment, and then start mapping which are the applications or softwares through which this particular transaction is getting posted in the environment all the way up to the books of account. Because today, if you see the information technology environments, one, they are no longer manual in any way. At a bare minimum, we see there are Tally and Zoho books and QuickBooks and maybe Navisions of the world getting implemented in these environments. While it is not just about one ERP that is there in the organization, you will typically see a lot of different applications and specific purpose applications that are getting implemented to enable the end-to-end chain of the transaction. So when we look at a simplistic, let's say a loan processing kind of a transaction, right from the loan origination system to the loan management system, and getting that disbursement posted in the end ERP software, either at a totality level or maybe at a transaction to transaction level. So you need to go the full length of the transaction, identify each and every step of the transaction, and assess which application system, which accounting software is this transaction getting processed all the way to the end. And that exactly will start becoming your scope to consider from an audit trail perspective. Now, when we look at this entire IT environment, it may not be just about applications. It has to be databases, middlewares, firmwares, interfaces, whatever else, where all the data moves from an end-to-end basis. But primarily, we will say application and database forms the primary base of this entire requirement, and that is where you will then need to see and focus on to say which application, what are the settings, how is audit trail needs to be enabled or not, how it needs to be managed, how it needs to be monitored, how accesses need to be controlled around that. Some elements of these configuration as well as access controls may get covered as part of the IT general controls as well. But in addition to the IT general controls, you will still need to look at the specific configurations for the audit trail purposes, and then start reviewing whether they are adequately enabled and not tampered with or not edited with throughout the year of reporting that we are looking at. Also, what is going to be extremely important is there will be a lot of different types of applications and softwares that are getting implemented. Everything may not be sitting in house. There may be something which is sitting at a third party vendor, something may be on a cloud, something may be on a country outside of India. All these different aspects may need to be brought into picture to say where what challenge may exist and how that needs to be maneuvered or cross in terms of enabling the audit trail and giving that required justification to say how it has been enabled and managed and maintained throughout the year. What is also important is there are various ways implementing an audit trail. So something may be simply configurable, while something may have to be programmed or hard coded in the program from an enablement perspective. So managements need to look at each and every software differently to say how I can enable audit trail in that software. What are the flexibilities or what are the configuration options versus coding options that are available in the audit trail that I can leverage. One last point I would add is when we are looking at an audit trail, the regulation, the way it is worded, it says the accounting software that is being used should be enabled for the audit trail purposes. A lot of times managements have come back discussing about tools and solutions which sitting outside of these accounting softwares. And I'm not saying that they are completely, not eligible to be considered. But as we consider those add-on tools and etc., there is an extreme importance that we look at the integration between the two solutions, that is the application system or the database, with these tools that we are considering. And also it may be essential to explicitly state it in the management's opinion as well as the auditor's opinion to say that the accounting software may not have this particular app, the audit trail, but that has been enabled through an external tool that is being put in place. So these are the few aspects that I would are today emerging and are getting more and more critical significance or importance from a reporting standpoint. Back to you, Vishalji.
Yeah, thank you, Kedarji. And I think you mentioned some important aspects that some of these softwares are configurable for the audit trail, whereas some have to be programmed. And I understand that many of these off-the-shelf softwares that you mentioned, they never had anything like an audit trail or things, but I think they have also come out with versions where the audit trail has been enabled, which meets the requirements of the management to maintain what has been mentioned in the rules, as well as for the auditors to report thereon. So thank you very much for your opening remarks, Kedarji, and we welcome our past president, sir, Manoj Fadnisji. Sir, welcome, and very happy to see you again in a quality cafe session at a very short time. I think it's just a few months back that we had you, and nice to have you back, sir. So we just started with the opening remarks from Deepaji and Kedarji. And sir, the question to you as a opening question, so being a past president also, sir, the audit trail, it's a new thing that has come. Definitely in our study material, in the audit paper, we used to read about audit trail and those aspects. But I think from a reporting point of view, from a management responsibility point of view, it is being mandated for the first time. So, sir, what, as per you, sir, can be the objective behind introducing audit trail to be maintained by the companies and reported by the auditors? And just to tag along with that, because such reporting is, I would say, reporting, specific reporting or requirement is not there internationally. And then why specific reporting in India? So your words of wisdom, sir.
Thank you, Vishal bhai, and thank you for inviting me to be part of this distinguished panel. I'm very happy to be part of this and sharing this with the other distinguished panel speakers. It is also a great pleasure to have our distinguished council member, CA Pramod Jain, who is incidentally attending this from my own city. And I was supposed to be with him and participate along with Pramodji, but unfortunately I got held up in some other meeting, and that's why I'm delayed here. And Pramodji, that is why my apologies to you. I could not be with you in the institute's premises at Indore.
Sir, it's my loss, sir. I could have met you one-to-one, but okay.
I'll still catch up with you. But great pleasure to have you and to also be to have your words of wisdom on this topic. So this is a very interesting topic, sort of a burning topic today with respect to audit trail happening for the first time in our country. And as you mentioned, Vishalji, there is no such parallel anywhere else in the world for the auditors to report upon. So there is no global guidance. But this is something which has come up as part of the Companies Act 2013 and the rules framed thereunder. I must compliment the Council and the AASB for the implementation guide, which is a very helpful and very useful tool and a document, which I would recommend to all to go through that in detail, because I find that guide actually addresses majority of the questions and queries that we as auditors may have. And it provides also as to what kind of reporting could be done with respect to the other clauses which are likely to be hit by the provisions relating to audit trail. Given the fact, I mean, what could have been the objectives for introducing this? I'm sure where the books of accounts are being maintained in a software, and in the absence of audit trail, it is possible that some of the companies or some of the entities may have not maintained the books of accounts on a timely basis, on a regular basis, or could have also distorted or deleted and edited or modified the transactions without them coming to the knowledge of the auditors. So in a way, mandating the companies to maintain their accounts with an audit trail, with an edit log which is available, which is tracked, would certainly give a lot higher degree of comfort and confidence to the auditor when he is carrying out the audit, and will certainly help in ensuring that the financial books of the company are properly maintained. Now, we find under the Companies Act, the basic provisions emanate from Section 128, subsection 1, where in that proviso, there is a powers given to the central government to notify by way of rules how the accounts are to be maintained if they are maintained in a soft manner. And arising from the powers given under Section 128(1), the Company Accounts Rules, Rule 3, contains the manner of books of accounts to be kept in electronic mode, where under Sub-Rule 1, this proviso has been introduced. As far as the audit rules are concerned, the company's audit and auditors rules are concerned, Rule 11, which derives the powers from Section 143, subsection 11, the Rule 11G has been amended to synchronize it with the requirement to maintain books of accounts. Now, there has been a disparity in the sense that the accounts rules became effective from 2023, whereas the auditing rules became effective from the financial year starting from 2022. Be that as may, it is 23-24 that is for the first time that the audit trail is being required to be maintained by the companies, and under Rule 11G, the auditors are to report on that. So I think this is a very dynamic provision, lot of different types of scenarios are there, because what is required is under softwares with respect to the books of accounts. Now, primarily it is and as that implementation guide very rightly brings out, it is the responsibility of the management to ensure first to identify which are the software relating to the books of accounts, and there could be other softwares, there could be multiple softwares, there could be situations where certain softwares are, or certain parts of the books of accounts are being maintained by other service providers, commonly like payroll accounting or items like that, which would also have an impact on books of accounts. So there is a wide variety of softwares which could be hit by the provisions contained in this rule with respect to audit trail. So given this, we also need to be cognizant of the definition of books of accounts as given in section 2 subsection 13, which relates to all receipts and expenditures and assets and liabilities, and which also extends to the cost records prescribed under section 148 of the Companies Act. And if there is by any chance any adverse comment being made with respect to the books of account, it would also have an impact with respect to what is the reporting requirement with respect to section 143, where the auditor speaks about the books of accounts being maintained, or under 143(3)(h), where there is a comment with respect to any adverse remarks which the auditor is required to report on. So there would be a variety of instances, different types of instances which would be involved while reporting with respect to audit trail. And as I said earlier, the implementation guide really explains the legal provisions, the technical provisions, and also what kind of management representations should be obtained, how they should be verified, and ultimately how the auditor should report on this and document his findings. So that implementation guide would really answer most of the questions that we have.
Thank you, sir. And I would say that yes, you have given an overview and also the objective for having such a requirement, because like you mentioned that there might have been softwares in use which are freely editable without any track or any trail being maintained of the changes that are being done, and especially maybe if we talk of the listed companies and all also, that where limited review results or limited the quarterly results get published, and then the numbers may undergo change in the software, in the accounting software, and there might be some instances that might have been observed by which this has been made a bit, I would say, more mandatory and requiring the reporting by the auditors also. So with this, friends, I would request the panel, the moderators, to take charge of the session and start with the interactive discussion with the panelists. So over to Ashish ji and Aditya ji.
Hello. Thank you, Manoj sir, Pramod sir, and Vishal sir for this opportunity. And I'd like to thank all the participants and all the members at Manoj sir, Deepa sir, and Deepa ma'am and Kedar sir for the very good and the very overview of all the session. So, sir, I would like to start with a question with the Manoj sir, right? So, my first question would be, is there any exemption available to small and medium category size firm or Section 8 companies for this audit trail?
So as the rules today have prescribed, there is no such exemption given to small and medium companies or companies which are registered under Section 8. And therefore, the provisions contained with respect to audit trail would apply to all companies under the Companies Act. Having said that, I would certainly agree with your question in the sense that maybe some exemption needs to have been carved out with respect to smaller companies, where companies may not be in a position to go in for a very expensive software with respect to ensuring that audit trails are available for all transactions. Because if you look at it, any transaction, any software which has an impact on the books of accounts would require the audit trails to be available. Now, many of the small companies, small and medium companies, or even Section 8 companies may not have those kinds of funds available or the resources available to ensure compliance with these requirements. And I therefore fear that some of the companies maybe, where the transactions are limited may ultimately report that they have not kept the books of accounts using electronic softwares, but have maintained it manually, because it is not mandatory that the books of accounts should be maintained only using software programs. If some company wants as an option, it can still maintain the books of accounts manually. And I guess some of the companies may, because of this requirement, may shift to maintaining the accounts manually, provided where the transactions are limited and the resources, of course, are limited. But as the rules stand today, there is no such exemption available.
Right, sir.
Manoj, so continuing with the comment that you had that it is required to be maintained by all categories of companies. Now, in a scenario where the audit trail is not being maintained or the software does not have that feature, typically the auditor is expected to report. Now, that's where the question comes up, where does he have to report? So what we look at is the Rule 11. That's the paragraph where we need to mention. I also observe that under 143B also, they will have to mention whether proper books of accounts have been maintained, except for, if there is no audit trail. There is also 143.3H. There again, a negative remark has to be mentioned. Apart from these three, if it relates to a scenario where the auditor concludes that it's going to be a material misstatement, or it could lead to a material mistake in the financial statement, then again in the IFC report also this needs to be reported. Am I right in saying that there are at least 3-4 places where the auditors may have to look into reporting?
Quite right. I agree with that. That depending on the kind of observations which the auditor has, primarily the reporting is under Rule 11G, but it has its consequences also under 143.3B and 143.3H, and as you rightly mentioned, IFCOFR would also be covered. But it depends on the facts and circumstances of each case, and depending on that, the reporting will have to be considered.
And when we
yes,
say
it would have impact at different places.
So when we say books of accounts, it also includes for certain type of companies even cost records also, right?
That is flowing from the definition given to books of accounts under Section 2, subsection 13, which defines the books of accounts, and it refers to items of cost as prescribed under Section 148 with respect to companies where cost records are prescribed. So in those in case of those companies, the definition of books of accounts would include the cost records. And in respect of each of these elements which come within the definition of books of accounts, the requirement for maintaining or having an audit trail, edit logs would be applicable.
Ashish, you want to take the next question?
Okay, sure, sir. Sir, my next question is to Kedar, sir. Clients wherein the application database server have been hosted outside India, along with a parent organization, how are the same being considered for reporting requirement?
Sure. So once again, I mean, I'll go back to what Manojji said. There's no exemption available, right? So given that consideration, I think first and foremost, we need to look at whether it's a company registered and operating in India or it is a foreign company. If it is a foreign company, it doesn't need to get included in the requirements of audit trail, although it is getting consolidated to a parent entity registered and operating in India. So that's the first and foremost thing. If it is an Indian company, registered and operating in India, even if it is getting consolidated to a foreign entity registered outside of India, it will still need to be, the Indian company will still need to comply to the audit trail requirements. That's the first principle. If the servers are located outside India, the compliance exemption is not available. You still need to, go ahead with that compliance requirements. But I'd like to add here a little more is a lot of these companies who have their parent organizations outside India or are having their servers located with the parent or a central setup somewhere outside of India. These are large organizations typically, and they will have multiple countries operating on a single instance of a large ERP like an SAP or Oracle or something like that, right? Now, these companies do typically are facing a big challenge in terms of enabling the audit trails, because once you enable an audit trails, like Deepaji mentioned in the earlier discussion, that these will consume a lot of space for storing the logs and will consume a lot of system time for processing the information. And that means you will need to have servers with a higher capacity, you will need to have a higher storage space, and all of that will add on to their cost. Now, for a parent or for a central team which is hosting multiple countries, when they have to enable some aspect of audit trail, in the environment, they will not be able to do it for a particular company in a particular country. They will have to enable it for all the companies and all the countries hosting out of that instance of the ERP software. And that is where obviously their cost and storage space requirements or various underlying aspects will, or the requirements, infra requirements will go up accordingly. And that is where one of the biggest challenge that the companies are facing today is in terms of how do we enable it only for a specific country, to meet that country's regulatory requirements. These are some of the practical challenges what managements are, or the dilemmas that managements are facing today in terms of the cost versus, how to enable in a little more practical manner, which will not add load on their servers and, end up into performance issues or so. So that is the aspect which is important. Having said that, I think if there are servers outside of India, there are two challenges. One, like I said, enabling these settings and managing, monitoring them for a larger instance versus a India isolated instance is a question of concern. The second bigger question from an auditor's perspective is how do I go and test it? Because all these environments are sitting outside of India. The relevant IT teams or the relevant teams which will give or provide all those details, documentation, etc., are based in countries outside India. And how do you really coordinate, collaborate? And sitting in a country, how do you really go and get these aspects covered? If you, even travel cost and all, you may be able to send a person into it, but companies may not be ready to sponsor the travel costs considering the size and scale of their operations in India. Some of that may be larger overheads to think for everyone. So these are some of the aspects that we are in constant connect with the local as well as the central managements to really figure out what would be the best alternative path to get the testing completed to enable the reporting. Mm-hmm.
Right. Peter, the other issue will also be like, okay, one is to check the audit log. Like the previous year, we started reporting on whether backup is available in a server which is physically located in India, and it's part of books of accounts, so that has to be maintained for 8 years. That's the requirement of the company law. What about audit log? Would it also require to be maintained historically for 8 years, or is it enough if they have started having the audit log from April 2023?
Yeah, audit logs are also required to be maintained for 8 years, but I'll only give a little bit of a twist to it. It is not historical, it is prospectively. So this being the first year, we will have to start from this year and go forward every year, and then make sure we have a trail of, maximum of 8 years available for any requirements that come up in the future periods.
Okay. My next.
I would just say, instead of a twist, I think that is a blessing.
Yeah, absolutely. No, historically, you will not be able to. I mean, we can't go back in time and recreate the fog, right? So it's not possible practically to go historically. It will
And
always.
it is not required also, because the requirement under the law is from 1st of April 2023. Only thing which I may like to add here is that the requirement under section 128 subsection 5 is for a minimum period of 8 years, as the law provides. So
Absolutely.
8 financial years after the end of this financial year. So from 23-24, our company needs to maintain it for 8 years, preferably a little more than 8 years. And if by chance any investigation is in progress, then of course the company has to continue to maintain these, and for all books of accounts.
Absolutely. Thank you for adding that, Manoj.
Okay, so my next question is to Deepa ma'am. Being this is the first year of this audit trail, so what if the company has operated the audit trail during the year? So what are the requirements? So, what are the requirements? What are the consequences that as auditor has to face?
Yeah. Thanks, Ashish, for asking this question. And I just want to make a point that I remember last year, having a session with Manoj sir on Rule 11E and F, and now we are on Rule 11G. Hopefully, we should not have more rules, adding more and more to the auditor's responsibility, just on the lighter side. And I think one important point, which even Vishalji mentioned, we have, the guide has a lot of guidance and the FAQs. So FAQs are very much based on your queries, members at large. So I think even what Kedar has just clarified, a very important point is captured in the guide that, you need to maintain that for 8 years, the audit trail effectively starting from, the year of first year. So I think that is something I just want to reiterate. And coming back to the very important question that, you mentioned, Ashish, about the fact that this being the first year of implementation, and there will be companies who actually enabled it in between the year. Very much possible, because, some companies are even making a comment and a representation that, we were not aware about this requirement, that, this was happening and it is coming to us late. So I think those things are obviously their perspective, but if you see the rules, itself is very clear, talking about the entire year. So it is unlike IFC reporting, where so here categorically the company's rule for the accounts rule as well as the auditor's rule talk about that the audit trail has to be checked and operated throughout the year. So MCA deferred this requirement, but now since it's applicable, so what needs to be required is if some of the software does not have the audit trail feature for the entire year, then the reporting, it's a factual reporting. I also want to put emphasis on this fact that this is a factual reporting, also clarified in the guide, because the auditor has to report audit trail is there or not. Now, if it is not there, then probably the auditor will have to ask more questions. And I think Manojji also very clearly explained that this may lead to more additional questions. Why the intent of the regulator behind issuance of these kind of a requirement? So I think if it's not there for any part of the year, that has to be called out in the report. And we have some very good examples of the wordings in the illustrative guide, calling about if it is not there for part of the year. So let's say the software, the audit trail feature was enabled during mid of the year, let's say July. You can check on the auditor can apply the sampling and can do a testing. However, if it's not there from April to June, then it has to be called out in the report. So, and also Manojji clearly mentioned about, the other reporting implication, and I think Aditya also clarified there. So yes, there was a lot of debate, and I think every question has a lot of thought process behind it. If you see, the drafting has also been very clearly, given that one, you please clearly explain what is the non-compliance, where audit trail is not there, that you will give in Rule 11G as an auditor in the report on other legal and regulatory requirements. Second, B is your master reporting clause for the books of account. So if anything is an issue for the books of account, you will have to call it out. So there also you will do the reporting, but you can draw reference to what you have reported in your other subclause for Rule 11G. So you don't need to repeat everything, but for the audit trail, you can make a reference. So the wording is very much there in the FAQ. You can have a look at the wording. And same goes for H. H is nothing but say it requires auditor to report any qualification, reservation, or adverse remark relating to the maintenance of account. Now, it's not necessary that every such remark or a comment or what you have reported in the Rule 11G is a qualification. So auditor needs to apply the professional judgment, and I would like to draw attention of the members here, even to the guidance note on the 143 H, which explains what is a qualification, reservation, or adverse remark relating to the maintenance of accounts. So I think that is something, the 3 reporting things which auditor will have to do. If there is an issue with the audit trail, either relating to a particular software or for any part of the year. And then we'll have to look at the IFC reporting implication also. And the wordings, I would strongly encourage the members to use the illustrative wordings given in the guide. There are plenty of example not operating effectively during the reporting period, maintained by the third-party auditor, but the auditor is unable to check. Not preserved by the company as per statutory requirements for record retention. I think all those wordings are very clearly given, which can really help the auditors. Yeah.
Nipa, just to add to your comment. Now, it's also quite possible. There are 2 scenarios I'm looking at. Scenario A is where the books of accounts are maintained in a particular application and possibly there's an audit trail. It's also quite possible some of the companies may be using a separate software, say for payroll or for accounting lease or say employee reimbursements, etc. Would that also be covered under the audit trail? Question 1. The question 2 that we also need to discuss is possibly that one of these could have an audit trail right from the beginning, but the other 2 or the other one may not have an audit trail right through the year. So I think to that extent, the reporting will also become more complex.
Yeah, and thanks for making that comment. I think it is very important. And as you rightly said, the company might be using different application of the software, different for the payroll processing or different for recording of sales or purchase. So I think that, and therefore the important point which comes into play is the identification of such software. So all such software which are being used by the companies, I think that is something which management needs to identify. And as an auditor, I think the first step should be the auditor should be asking from the management, please give me a list of the system and transaction relevant to the books of account with information. So before doing the testing. And second thing which you mentioned, for that is complex, I agree. And but at least you have a base to start in the guide that it is there for one software, it is not there for the other software, or it is there for part of the year. So probably, and therefore, if you remember in the beginning, I mentioned management note. So if there is such many situation or combination or instances, it would be highly, in my view, it would be highly advisable for the management to include a detailed note so that the reporting can be, much more broader and can draw a reference to the management note as you do in your auditor's reporting, modified reporting. Yeah.
Okay. So my next question is to Manoj sir. So even though the books of accounts are required to be maintained every day, but there are instances where small companies are maintaining their books of accounts at the year end. So what are the integrity of that accounts of the financial statements, and what are the reliability? What are the as an auditor we are required to report? So this is my question, sir.
Good question. Again, from the point of view of small and medium entities which may not be maintaining the accounts on a
regular basis
or for the entire year, so to say, on a regular basis. But I'm sure the companies would be maintaining at least their cash book, and mostly they are even stock records on a regular basis. So even if the finalization and other transactions are being recorded periodically or maybe towards the end of the year, but so long as the cash book is maintained on a daily basis as is required, I think there should not be too much of difficulties, more so in case of small and medium entities and small and medium companies. That is because if the information is available with the companies to compile that information. So take, for instance, the sales transactions and the purchase transactions. If the sales and purchase transactions are being accounted at the end of the month, or at the time of finalization of the GST records, GST returns, that should not be too much of a difficulty insofar as the reliability of that information for the auditors from the auditor's point of view. If the say other transactions with respect to finalization of record accounts some of the provisions which are required to be maintained, or some of the other transactions which are there are, say, captured at the end of the year. I don't think that by itself should create difficulties. But of course, if it is a large organization and it is not maintaining accounts on a regular basis, it would certainly call for qualifications, and the weaknesses in the internal controls will have to be called out. So what is important is the size of the organization, the nature of the organization, and what kind of records are being maintained on a day-to-day basis, and what kind of records are being maintained or being captured, what kind of transactions are being captured at the end of the year. And depending on the severity of such transactions, depending on the impact of such transactions on the financial performance of the financial position of the company at the end of the year, depending on that, the auditor will have to give his audit report. So in some cases, it could call for qualifications and appropriate adverse remarks. But in many cases, in small and medium companies, merely the fact that the larger number of transactions are being accounted for at the end of the year would not by itself indicate weaknesses in the internal control. So on a factual basis, one would have to look into the scenarios.
Pandit sir, if I may just ask or maybe continue with that, that many times what has been observed is, the typically, especially in case of the trading companies or companies in the trading activities, and so they do maintain the cash book, the bank book, the inventories, they keep it manually. And then what happens at the end of every quarter or maybe at the end of a certain period, all those transactions from the manual ledger or the khata bahi, which we normally say, they are posted into the accounting software. And so in that scenario, still the reporting, the reliability would be for the software, which may not be on a daily basis, because daily it's a manual book which is maintained, and then the transactions, but they are dated the date of original transaction, but entered in, I would say, like like a batch processing.
So a very practical scenario where, say, the cash book is maintained manually, but so long as the daily cash balances can be extracted and it can be determined what was the cash on hand on any particular date, what was the receipts and what were the payments which could have been made on a given date. If the cash book is, say, with a accountant or a cashier is maintaining it, and out of that the information is being incorporated in the accounting packages on a periodic basis, as you mentioned, even then, for the purposes of the audit software, the company will have to ensure that the software has an audit trail. Even if it is a small company, as we discussed, there is no exemption which is available to a small company. So the company has to decide whether it wants to maintain its books of accounts either manually or using a software. I'm sure there cannot be a situation of a hybrid where some of the items are on cash book and or say some of the items are in manual and some of the items of the books of accounts are in a software program. I don't foresee such a kind of a scenario. So either it is manual or it is using a software. And even if it is a software, the requirement which we are dealing with would require the software to have the audit trails. Now, as far as the weaknesses in the internal controls are there, if the manual accounts are incorporated in the software on a periodic basis, say once in a quarter, once in a half year, or maybe at the end of the year, what is the veracity of those transactions which are recorded manually? Are they auditable? Are they as I said earlier, is it possible for me to extract the daily cash balance? Was there sufficient cash on hand? Whether the payments which were made were actually made on that particular date would be a subject matter for the auditor to see and verify on a case-to-case basis. but it would certainly indicate the weaknesses in the internal controls. It's not a desirable situation for any entity to have that the accounts are being updated or being completed once in a year. Ideally, it should be done on an ongoing basis, and that is what gives the comfort to the auditor when the auditor is certifying the applicability of the IFC of OFR. Now, IFC OFR would not apply to all companies. As we know, it applies to companies above a particular threshold. So, in those cases, it would be very important to see that what kind of transactions are being recorded manually and at what point of time they are being incorporated in the software.
Manoj sir and Kedar sir. So while we are in the discussion of having manual set of accounts or possibly certain amount of manual intervention would be required, but if you look at the preparation of the financial statement as such, right? Almost all the cases, the financial statements are prepared in Excel, right? That's the tool or similar spreadsheets. So is it a requirement that even the Excel sheet should also have an audit trail? How would that be possible? Or possibly there could be certain calculations that are made in Excel, say possibly inventory calculation or bonus calculation, provision calculations. So is it expected from the rule that even that should have a trail?
So, audit trail would be required where there are softwares being used for the maintenance of books of accounts. Now, if that Excel sheet is part of the books of accounts or is not a part of the books of accounts, as the implementation guide says, it is for the management to first decide what are the different types of softwares being used for maintenance of books of accounts. Now, merely because if a spreadsheet is used for calculations, as you mentioned, for say depreciation calculations, bonus computations, or some other such type of calculations, and because it becomes easier to do those calculations in a spreadsheet, would not by itself mean that that spreadsheet is part of the books of accounts. But if the spreadsheet is used in such a way that it auto feeds into the books of accounts, then that spreadsheet would be part of the books of accounts. And if so, then that spreadsheet should also have an audit trail. So essentially, the management would have to decide what are the software programs being used with respect to its books of accounts. And the auditor will have to apply his judgment to see that all relevant softwares are being considered. And if they are part of the books of accounts, then the requirement for audit trail would apply to them.
And if I can add here, just to what Manoj sir explained, in a very simple manner, I think this was debated a lot in even the meeting when these questions and the guide was revised. And definitely there was a lot of challenges around the Excel. And if there's a specific question given in the guide which explains that if you're just maintaining, if you're using the spreadsheet for your preparing your workings or calculation for the amounts to be recorded, then probably it's not part of your books of account. And if there is a direct auto interface for the if you're maintaining your books of account in Excel or the spreadsheet, and if it has a direct interface to your system, to the accounting software, then it is part of your books of account, which has to be tested for the audit trail. So I would just want to mention here that probably it is important to read that FAQ to get that perspective, because yes, this was a challenge highlighted by many of the members when these questions were received by the AASV. Okay.
I'll just add some examples here. I mean, completely concur with what Manoj has said, as well as Deepa mentioned here. So in case of examples like where let's say the entire calculation, like let's say depreciation calculation, is carried out in an Excel file or an inventory valuation, and then somebody is reviewing that and then taking the final number associated to the posting and making an entry in the ERP software for the depreciation recording and etc., then that may be considered as out of scope, because that is only a calculation that is performed in the Excel and not typically generating an accounting entry. But if you look at something else, like in one of our clients, where we are seeing that there is data which is sitting in the in-house system and there is data sitting in the vendor system, Both these data are brought together in an Excel format where a reconciliation macro is executed, and the output, it's a rule-based macro. So as output of the macro, it creates certain output files which straight get auto uploaded into the ERP for making a posting in the ERP. In those kind of circumstances, that entire Excel macro and the associated Excel data file will have to be considered as an audit trail. And although practically we may say maintaining an audit trail in a software like Excel is not a practical approach, but that is where, like Manoj sir mentioned, companies will have to take a decision on how long to continue with such softwares, or when to upgrade to a more appropriate, which will be enabled or which can be enabled with the audit trail solution.
Okay, so let's move on to the next question. Sir, my next question is to Kedar sir. Sir, in many big organizations, it is seen that the different users are created for to assess the books of account. So my question is, where certain users have master right to modify the data logs, would it be a non-compliance of audit trail requirement?
Yes and no, because and I'll reword that terminology of master right, because typically in the industry parlance it is called as privileged access. So I'll rephrase that to be called as a privileged access in a way. So privileged access always is one of the sensitive and critical accesses. Typically, it is associated to people who are subject matter specialists on managing, maintaining, the databases, application systems, operating systems, or any of the technology elements associated in the organization. So first and foremost is, as an auditor, as a management, you need to ensure that this access is sensitive in nature, and that's why it's restricted to the right set of people who have the capability or the right knowledge and the skills to manage and administer these databases. Also, another aspect that we need to take into consideration is any of these log tables will be heavy in terms of size, right? And even SAP kind of softwares will have limitation in terms of the GBs that can be allocated to these log tables. And as these GBs gets used completely, they will typically get overwritten with the fresh logs, and the older logs will get auto deleted simply because of the way the systems are functioning, the way they are configured and functioning. Now, to ensure that when the logs reach to its maximum capacity, the administrators have the ability to sort of archive these logs and free up that space allocated to that log tables, so that the newer logs can keep getting accommodated without deleting the older ones. So the access is not like is not needed or is frivolous or something like that. It is genuinely required to administer and manage and maintain the health of the system as well as the health of the logs. But my view is, till the time the managements have enabled processes around it to manage and control this and record what exactly is being done by these administrative or privileged users, I think we should be able to cross that bridge to say that because of the controls put in place and the detailing mentioned and the review procedures associated to that and the way it is being executed, we should be able to go ahead and rely on those logs that are available in the system as well as archived, for a future reference.
Sir, continuing with that, two I have is, suppose if there's a company which is very, very small and very limited transactions, and they have chosen to maintain the books of accounts manually, right? Because there are very, very few transactions. So should the auditor expressly mention in the audit report that the books of accounts have been maintained manually, and therefore, there's no occasion for the auditor to, do the check of audit trails since there is no software use?
So under section 11G, I'm not 110% sure, and I'll probably ask Manojji or Deepaji to support me over here. But there are certain other sections where I'm sure we'll have to disclose as to how the books of accounts are maintained, whether there are accounting softwares or there are manual records maintained and appropriately stored and etc. Maybe Manojji, Deepaji, if you can add to
So
this.
I concur with what you said, Kedari. In fact, if you go through that question which is posed in Rule 11G, it says whether the company in respect of financial year commencing on and after 1/4/22 has used such accounting software for maintaining its books of accounts. So it starts with the question where the company is maintaining accounts using an accounting software. Now, assuming the company has maintained accounts manually, the auditor would have to bring out that the books of accounts are maintained not using an accounting software and they've been used manually, and which is still in compliance with the requirements of the law, because as I mentioned earlier, what the rule follows what is there in section 128. And 128 subsection 1, the proviso says that where the accounts are being maintained using an accounting software, the manner in which the accounts are to be maintained will be such as may be prescribed. So section 128 does not mandate a company to use an accounting software. It only says that where the accounts are being maintained using an accounting software, it would be in such form as may be prescribed. And in the rules, it is brought out that where an accounting software is being used, such software has to be one which has an audit trail. And therefore, where the accounts are being maintained manually, the factual position should be brought out by the auditors in respect of this question under Rule 11G in the audit report.
Right, sir. And what would be the role of the management representation letters? Because some questions we have is, can we take a representation letter from the management that we have an audit trail? That would not suffice the purpose, I guess, because representation letter by itself is not an audit evidence. Right?
Yeah, yes, quite right. I mean, management representation letters are the starting point. The auditor is supposed to verify those what is being represented to him, and in no case or in no situation the representations can be accepted as they are given. The auditor is duty bound to audit those representations and come to his own conclusions.
And the representations will be more in line of saying whether there were any fraudulent scenarios that as an auditor, the management has to disclose, or if there are any deficiencies which were identified as part of the audit, will have all of those been disclosed to the auditor or not. And that's where the representations will come in from. But like Manoj sir mentioned, we cannot close the audit only on the basis of representation letters.
And the implementation guide also gives the format of the letter that needs to be taken.
Right.
Okay. So my next question is to Deepa ma'am. Ma'am, can the auditor use an IT expert while auditing and reporting on the audit trail feature of the accounting software?
Yeah. And I think, again, on the lighter side, so when this webcast idea came, I said we cannot have it without a technology expert on the panel. So yes, an auditor can use an IT expert, and because, there's some complex system where you actually help that expertise to evaluate the management controls and configurations in the accounting software regarding audit trail. And when you talk about the expert, you already have a standard in auditing, which is called SA 620. So the auditor will have to go back to it, that the ultimate responsibilities lies with the auditor. Yes, you can use the expert, you can understand the management control, you can see the testing of the audit trail, you can understand like privilege access management tools or rights, what Kedar just explained. And in some cases, you may have even a third-party service provider where you have the SOC report, which is called a service organization control type 2 report. And there also, in some cases, you may want to take in support from the IT expert to understand the report and the testing done by the third-party auditor. So I think that is something wherein the expertise role is very important, and yes, an auditor can take the help of the expert, like you use your other expert, valuation expert, actuarial valuations. So this is something very important. Yeah.
So Aditya sir, do you have any question or any?
I have one question arising from Deepa's comment. Typically under SA 402 also we are expected to evaluate the internal control of the service providers, right? So those companies which are taking the support of service provider in terms of, say, payroll management or accounts or anything like that, should they be taking any additional report on this, or should we take the evidence that the service provider is also maintaining the audit trail?
So I think thanks for highlighting that. Yes, the requirement is to have the report from the third party service provider, from an independent report covering that the audit trail has been maintained throughout the period, throughout the year, and the auditor can rely on that report. In the absence of the report, the auditor will not be able to rely on the report and do the testing unless and until the auditor himself or herself can test. So, and if there is no such report and the management is just making a statement, okay, we have a third-party service provider, the audit trail feature does exist, that is not sufficient. So, in the absence of the report covering the entire period starting from April 1, 2023 to March 2024, it will not be sufficient for the auditor to report on this.
Okay. So my next question is to Manoj sir. Sir, I would like to ask a question. How does the audit trail play a very critical role in detection and prevention of frauds? It will be great if you can give some examples with this point.
Well, the whole objective to my mind of ensuring that there is audit trail is to ensure that if there is any falsification of accounts being done by any company, so there are effective checks and balances to ensure that it is not so done. So when the accounts are being, in the good old days when the accounts were being maintained manually, you could see the books of accounts for the full year and you will find out where there are any changes made. If any transactions have been deleted, it could be noted, because if there are entries made in the books of accounts and if it is to be deleted, it would be striked through, or there would be some evidence available. So when the accounts went from manual to computerized system, many a times it could also happen that some transactions are deleted at some point of time, and again they are restored at a later point of time, and none would be aware that they were deleted for a particular period of time, or they were altered or modified in some ways. So the falsification of accounts, which could take place if there are no proper audit trails available, and I don't mean to say that every company intends to falsify its accounts, that's not what I'm saying. But as an audit satisfaction that you want that the books of accounts have not been altered, the transactions have not been altered during the year. Now, typically, in case of many entities which have cash credit limits and other facilities from the banks, and there are covenants from the banks which require the borrowers to adhere to certain norms. So take, for example, the funding which is done by the banks on receivables. And the receivables have to be for a particular period of time. So they are, say, within the last 60 days or last 90 days, and only those receivables are available for calculation of the drawing power. Now, in absence of an audit trail, it could be possible for a company to change the date of invoices and see that the aging falls within the prescribed time period as stipulated by the banks. And after the drawing power is marked, again restore those invoices to the actual dates so that there is a proper matching with the party at the other end. So there could be multiple examples where the accounts could be falsified if the proper trails are not available. Now, given the fact that you have the audit trail now, and the auditor, once he sees that there have been transactions which were deleted or they were modified, the auditor is supposed to inquire. The whole purpose of audit trail is not just to be satisfied that there is an audit trail available, but if the audit trail shows that there were certain transactions which have been modified, which have been deleted, the auditor is supposed to dive deep into those areas and find out what was the reason why they were deleted, what was the reason why they were modified. There could be genuine reasons. There could be reasons that the transactions were wrongly entered, and therefore they have been modified, therefore they have been deleted. There should be valid reasons. But if there are no valid reasons, then the auditor is supposed to dive deep and see why they were modified. So the whole purpose is to ensure that the accounts which are prepared, which are there, and the financial statements which are drawn basis those books of accounts, and given the fact that the auditor is doing a sample checking and not really verifying 100% of the transactions, the audit trails would give the auditor a better comfort with respect to the authenticity of the books of accounts.
Okay. So, Aditya sir, yes, please.
So there are two things. One is reporting by the auditors, right, and using the work of an expert, etc., and preparing the financials. So when we move up the chain, where we also need to work on or report on the consolidated financial statements. So what should be the responsibilities of the auditor of the consolidated financial statement? Would they have to give this in the group audit instructions to the subsidiary auditors, and they should have discussions with them? Or if there are any negative comments by the subsidiary auditors, should that be carried out in the consolidated audit report? Or would there be even there, if it's a very, very small subsidiary, it will really not impact the consolidated financial statements? Is there any exemptions available for not reporting it?
So is that question to me, Mr. Aditya? Then my view on that is, again, depending on the size of that subsidiary in relation to the consolidated financial statements. And consolidation will be of all the group entities, and all the group entities need not be companies. So if you have group entities which are not companies and to which this rule does not apply, you would have in the consolidated financial statements some of the components which are companies which have this requirement. You could have in the group some companies which are incorporated outside India, and as was clarified by the other panel speakers, that these provisions will not apply to a foreign company, would apply essentially to an Indian company. But you could, so some of the components in the group may have this, some may not have this. Now, given that kind of a scenario, if you find that a material subsidiary, now there is a concept of material subsidiary under the listing obligations, LODR. So if you have a material subsidiary and the material subsidiary carries a qualification with respect to the software which is being used, I'm sure it is the duty of the consolidating auditor to give due weightage to that qualification done by the auditors of the such subsidiaries. But assuming that in a large organization with large number of subsidiaries, if there are some components where there are qualifications, then basis the materiality concept and basis the overall view that the auditor may take, the auditor may choose not to report in the consolidated financial statements about insignificant subsidiaries having such kinds of qualifications.
Yeah, and if I can add, I think Manoj sir, you have rightfully answered the question. I think I just want to add to one thing. One is on the group instructions part. Yes, in my view, part of the group instructions to the component auditors and which are covered under the purview of the Companies Act. So it can be even a foreign company, which is a company under the Companies Act, like license office or the branch office. And the instructions should be issued at the appropriate time so that the reports are made available to the group auditor before issuing the consolidated audit report, because there could be a possibility that there could be a different reporting year-end. The other thing which I want to highlight is on the, we have SA 600 and the guidance note on consolidated financial statement, which gives a guidance on what Manoj sir explained, that depending on the materiality, the auditor can exercise a professional judgment. But yes, if there is a modified comment in Rule 11G, then that has to be considered and reported by the parent auditor. But yes, the materiality and the professional judgment remains as a principle, which is also explained in your SA 600 and the guidance. Yeah.
So, sir, Kedar sir, do you want to add on something on the consolidated financial statement point?
No, I think Deepa and Manoj sir have already added. So
okay, great, sir. So my next question is to Kedar sir. So the question is, key or large ERPs have released press note confirming that there are software that are complement with the requirements of the audit trail. What additional is expected to be performed by the management in case of these scenarios?
Yeah, I think these notes, I mean, a lot of OEMs have today, released these notes, but these notes are at a very, very high level or at a superficial level. Ultimately, like we say, the proof of the pudding is in eating it. All the access restrictions, the configurations, the enabling of it, the managing and monitoring of the logs, identifying the accounting transactions, and ensuring that all of those are, identified as part of the classes of transactions and the events when you're configuring these into the ERP application. Maybe even if it is a table level logging, identifying what are those relevant tables from an accounting entry perspective for the given the customizations or given the enablements that each client may have done in his or own instance of the application. I think all of those things need to be still put together by the organization or the management, and it has to be tested and ensured that it is stayed good throughout the year to enable a positive reporting. So all those aspects will still need to be brought into the picture here. The OEM notes are at a very high level, and they still need to be applied, and so again, and that's end of the day, that's more like a guidance that is there. Now, the regulation also requires us to look at database logs. Most of the OEMs have recommended or given the information that database logs enablement is not suggested because it puts pressure on the load of the system, and there may be performance issues because of that. But then, how do you find way out of to ensure that the performance of the system is not affected, but at the same time you are able to log whatever is relevant? And I'll go back to my first question. In a couple of clients where we saw when the table level logs were enabled, it really did put a load on the performance of the system. But what was important there was to fine tune that to say what exactly is relevant, what is not relevant, or what are those specific tables which are putting the load on the system performance, and what options do we have for those specific tables to go ahead. So that applicability or the application of that guidance or that information what has come in from the OEMs is also extremely critical and necessary to achieve the end result. So none of the OEMs are, except for Tally, where Tally has declared that a few versions, I think 2 or 3 versions of Tally now are compliant to the requirements. But at the end of the day, if you ask me, the log requires you to identify who, when, and what, right? Now, in a Tally kind of an environment where if you are having all generic user IDs and they are not named user IDs, to the names of the employees who are performing these transactions in the environment, then your end objective of that who will still not be achieved. And that's why you will need to look at it with that critical lens and not just take these guidances or the notes that have got released from OEMs at a face value. It will still need to be applied in each and every single instance or each and every single organization to say how these needs to be implemented and applied in the given organization.
Okay.
Ashish, just to add to especially with SMEs or other type of organizations similar to that, the auditors could also face challenges where the management is not really very helpful in providing the audit trails, right? So is it that the reporting would be sort of restricted only to the Rule 11G reporting, or should it also go to the modification of the audit report? Deepa, if you can answer that.
Yeah, very relevant question. And I think it's a clear-cut case where the management is not complying with the mandatory requirement of the Companies Act. So I think the responsibility, the auditor will not end by just reporting in Rule 11G that it's not available, but one has to dig out on the reasons, speak to the management. What are the reasons why it is not available? Is it a system issue? Is the software being used is such that they do not have the audit trail feature, which means it's a system limitation, is still a non-compliance, because when the MCA has given 2 years, effectively the intent is the management should move to the software which has an audit trail feature. Two, if this is something they do not provide access to the company, to the auditor, then it's a clear-cut case where there is a scope limitation and the management is not providing the information. Then probably we'll have to do a larger assessment and do an assessment of the risk of material misstatement due to is there any issue with the integrity management override or the integrity of the management, and we'll have to think about even the impact on our other reporting, like the IFC reporting You have the 143.12 reporting. If there is an issue, you have the clause 10 reporting in Caro. So what I'm trying to say, the whole gamut of reporting for the auditor, just understand the repercussions. So whenever you find anything, even if it's an unusual transaction or anything which you notice out of audit trail, you can't just stop it here. So you'll have the auditor will have to think and apply the professional judgment, wearing the head of the auditor. Okay, what was the intent and what can be the repercussion? Is it something it's intentionally being done, or it's a deliberate this thing, and therefore the responsibility is larger, and which may even lead to a modification in your main report.
So can I also add on to that very interesting debate? And I agree with how Ms. Deepa has really explained the various aspects, while I concur with that. And as she rightly mentioned, it is a question of professional judgment by the auditor. So we should also be mindful of the fact that this is a legal requirement. This has come in 2021. It was to be made applicable from 1/4/21, and obviously it got deferred to 2 years. Now, given the fact that this is a legal requirement to have an audit trail, there is no two options. The companies ought to have this audit trail. So it's not whether there is a choice. There is no choice. The law requires, if it is a case of a company, the company is bound to have the audit trails. But but not having an audit trail, does it mean that the internal controls are weak? Not having an audit trail, does it mean that the accounts have been falsified? And does it necessarily require a qualification? So that is where, as Deepa mentioned, the professional judgment is required to be applied. So for all these years up to March 23, let's say there was no audit trail. And in spite of not having audit trail, the financial statements were being certified to be showing true and fair view. The internal financial controls or financial reports were also being given a clean report. Now in 23-24, the situation has not changed. The operating situation at the company has not changed, except for the fact that there is a legal non-compliance. And that legal non-compliance has to be brought out in Rule 11G reporting. But does it really mean that the accounts do not show true and fair view? The answer may be no. The financial statements, the internal controls may still be good enough that even in spite of not having an audit trail, the accounts are showing a true and fair view. And that is how the financial statements were being verified and were being audited up to March 23. So we need to keep, as an auditor, we need to keep in mind and balance the requirements. One is, what is the legal requirement? If the requirement is not being complied with, we need to categorically say the factual position under reporting under 11G. But in respect of the other matters, depending on the facts and circumstances, depending on the audit findings, depending on what is the impact of those audit findings on the overall financial statements, the auditor, as she mentioned, has to take a professional judgment, look at how the auditor has done the audit and the risk assessments in the previous years. What are the procedures which have been followed? So as I said, just give an example that maybe the receivables could have been falsified. And if the auditor has seen the statements given to the banks, and now that is also a part of Schedule 3 and the CARO requirement to see what is the stock statements given to the banks and what is the stock as per the books of accounts. Now, if these are all in order, or whatever are discrepancies are being pointed out, then basis that the internal controls may still show a true and fair view, whereas the 11G requirement would be a qualified requirement. So in that sense, I would suggest one should take a professional judgment and balance out the reporting requirements.
Yeah. Thank you, Manoj sir. And I just want to highlight two very small points emerging out of this. One is, I think, yes, if the management is not complying with this, so whatever be the reason, depending on the facts and circumstances, the company should make a provision for what you clarified on the penal provision. And I also mentioned in the opening remarks, which is there in section 128, subsection 6, there is a penalty. So I think auditor can check that whether the management has made that provision. And second thing to keep in mind, it will impact the next year reporting. So this is one of such reporting requirement which you will carry forward. So next year, again, because the logs are required to be maintained for a period of 8 years. So when I'll come to the next year, and if I do not have the audit logs for 23, 24, and even if you have for 24, 25, your reporting for 23, 24 will still be there. So that's the only thing I want to highlight.
Yes. So my next question is to Manoj sir. Sir, how should an auditor report on key audit matters related to significant findings in audit trail as per the Companies Act 2013? Include guidance on how auditor can effectively communicate these findings to the management and the shareholders, ensuring transparency and accountability.
So, good question. I mean, in the sense that there are different reporting requirements and different communications which require to be given. One is to the shareholders through the audit report, and separately also a report or communications with those charged with governance. Now, in context of the reporting requirement under 11G, the factual position requires to be mentioned, whether there is an audit trail or when, what, how it is, as was mentioned, how they are being complied with in respect of the requirement for maintenance of accounts under the company's accounts rules. So the auditor needs to give a factual position. Insofar as the key audit matters, and as ISA 701 explains that position in elaborately, that is where significant judgments are being made, or there is a reliance being put on certain judgments being taken by the management. And under the reporting under 11G being a factual position, the reporting to my mind would be made under the requirements under 11G. And in case there is an adverse remark, as we discussed earlier, under 143(3)(b) or 3H, the reporting would be done. And besides that, in respect of communication with those charged with governance, the auditor is encouraged to communicate with the audit committees and the others in the governance as to what are the different aspects which he has come across and share his findings with them. At the same time, what is reported to the shareholders should not be in contradiction to what is being reported to those charged with management.
Manoj sir, we are also having a few questions coming out from the audience in this webinar. So I'll just try to pick up a few questions. One question that we have is, would it also apply to the reporting in case of audit of banks and other cooperative societies, cooperative banks, insurance companies?
So this is a reporting requirement under the Companies Act.
Companies Act, yes.
So therefore, any entity which is registered under the Companies Act, be under the 1956 Act, which is a company under the Indian Companies Act, to that, this would be applicable. So if you have banks and non-banking finance companies, which are NBFCs are companies, but banks could be companies, banks may be incorporated under the other laws also. So to the extent they are incorporated as companies, this provision would apply. But certainly to cooperative banks or other such entities, this provision, this reporting does not apply.
Okay. So let's move to the next question. The next question is to Kedar sir. Okay.
Sure.
So, sir, the edit log is required to be maintained for 8 years. How should the auditor ensure that the edit log is the same file that was created when the financial statement of that year was signed off? What if there is a change in the date of the modified field? Which can happen due to a number of reasons? So, would you like to throw some light on it?
Sure. I think there are 2 or 3 perspectives, and I'll try and cover them separately. Because when you're looking at the edit log file, till the time, let's say the log file is in the system, in the primary system where it is got created, you'll have enough data points available in the system to say which particular accounting entry related log entry was created when and where and how and etc. And assuming that nobody has access to go and edit or modify those log tables and etc., then it should not be a big issue in terms of identifying or substantiating that nobody has gone and edited these logs what are there in the primary system. Second aspect is archiving of these logs and availability of these logs at a later point of time, and ensuring the security or safety or uneditability of these archived logs specifically. So when the logs do get archived, you will have an object name and object date and etc. that is getting created. And changing an archived file is not an easy task. I mean, there we need some tools, technologies, softwares to be made available to do that. Also, the object date and timestamp will change in case you have gone and edited these logs after the date of archival that you have had on it. So somewhere we'll have to put a process. I mean, first management will have to put a process in place to monitor that these archived dates and etc. are not changing. And if they are, then they will have to substantiate why a archive date got changed in the object. And if that is the case, then what are the repercussions or implications of that change in any way, as well as the auditors will need to validate whatever management has been doing as part of the review controls that have been set up towards these archival of logs and etc. But I think at the moment, as auditors or as managements, these are a little early days. Companies more or less are right now in the phase of either partial compliance or getting there to the full compliance status, and there will be very few companies who have already achieved a full compliance or are achieved it right from 1st April onwards, as we see it in the marketplace today. Right? Given that fact, the question in terms of the archivals and the security of the archival and how to track and maintain that, this will probably come up by the mid to end of the next financial year, that is the 24-25 financial or accounting year basically. So maybe a little early to really experience that and answer that question in a little more granular details is what I would say.
But Deepa, we have a question from one of our audience. There are two parts. What exact evidence needs to be obtained and preserved by the auditor as part of their working papers in respect of audit trail? And if audit trail has been enabled and not tampered throughout the year, but the auditor observes that there are a lot of entries that are passed and which seem to be suspicious, would it require further investigation?
Yeah. Thanks for raising this. And I think it's very important because whatever you audit has to be supported by your documentation. And therefore, it is so there is a standard SA 230 also, which requires you to maintain a proper documentation. So I think whatever logs you will check based on the basis of the sampling, the personal interviews. So for example, you will have a interview and a discussion with the IT team of the company, or maybe in a smaller company with the management to understand how they are having that feature, what they have enabled, and how they are checking the management controls. I think that minimum documentation should be there in your file, that what are the management control, which were the software you were tested for the audit trail, sample some of the record of the logs which have been tested. And if you find any issue with them, how you resolve with them. So just apply a simple, like you do your other reporting matters. What was the management step? First of all, what was the evidence you obtained? Were you able to check that? And were you able to observe any or independent audit evidence? So therefore, it's very important that the trail has to be there. The system should have the feature to generate the entire trail or the logs, the edit logs, which you can check. And you need not retain everything in your file, but yeah, maybe on a sampling basis, that is something you should keep with you. And in terms of the second part of the question, that what if there is a suspicious transaction, or you say that, there's some modification happened other than to, by the authorized person, or you see any other red flag. So I think, again, I'll go back to the other question which we discussed, that your responsibility does not stop there, just saying that, okay, you will have to do further understanding why these, what are those transactions, why those unauthorized entries were made, or what are the, cause for such entries, and what is the impact. So it is very much possible that it may lead to the additional procedure on your other aspects, and at the end of it, you may end up performing more procedures to see whether it has an impact on the financial statement and whether it has an impact on the true and fair view of the financial statements.
So I think that is something very important. And if in any case, whatever you find, my suggestion will be, and what Manoj sir explained, please have a communication with the management, with the board, with the audit committee, whatever the size of the company. And I think there's a very important standard, SA 260, which talks about communication with those charged with governance. So that communication should also be part of your documentation, because this is one of the very important finding by the regulators, that there is no evidence, no record of communication. So if you find something, how you resolved it, what communication you made to the management, that should be part of your documentation.
Kira, just a follow-on question. This now, when we say, okay, we verified it and we have evaluated the audit trail, question is, how much should I verify? I mean, with largely the principles with IT controls is, can I just test one of them and conclude that the trail is there, or should I take certain amount of samples? And I go back and look at the guidance note of ICA on the IFC reporting, which gives that table of what should be the minimum sample size. Should I use that and say that I've taken, that is the minimum samples that I've tested, and from there I conclude whatever conclusion I arrive at? What should be the approach the auditor should take there?
Very valid question, and I think that's a pertinent question at the moment, because as the auditors are getting into more and more details in terms of testing, I think the first and the foremost thing you need to confirm is your configuration controls and your access controls are adequately set up in the environment to give you the comfort that the audit trail was actually enabled throughout the year and there was no tampering or no edits made to those configuration settings through the year. So I think that is something which is of the utmost importance, and those are all system-based control. It is not a process-based control where a sampling approach can be brought into picture. So when I look at a system-based control, there will be a test of one of that particular setting being enabled, disabled, and the logs associated to those settings to say whether this log was edited during the year of the audit. So there will be some security logs also that you will need to test to say which user had access to edit these settings, what period of time, and what was done or not done during these. So some of these log-based reviews and all that, there you may adopt a sampling approach. But for configuration and all, it will typically be a test of one that you will need to do. Having said that, what is also important here is not just to look at the controls and be done with it, but also go a little substantive way to say that, whenever you are doing your substantive testing and etc., maybe pick up samples from there to trace it back to the audit trail tables and say whether the samples that you have selected throughout the year for testing, have there been enough audit trails created for those samples. So that is also another way to look at it and, coordinate along with your existing work on audit and add a step to it to go back and check the audit trail so that you're not sort of overloading with too much of increased amount of work, but at the same time you are able to say that whatever configuration settings and whatever log reviews and etc. that you have done as part of the audit trail review, you are now able to substantiate it also throughout the year, that whenever a transactions occurred in the environment, they were triggered by the log as well, which is maintained and available in the environment. So that is how I will put it, to say comprehensively how we can cover it between a sample testing approach as well as a configuration testing by way of a test of one.
Yeah, thank you, Kedar bhai. I feel the questions would go on and on, but we are maybe we would have one more such webinar going forward, maybe 15-20 days down the line, when we have more information and experiences to share. But before we wind up, just I would ask each of the panelists, starting with Kedar bhai, that this being a new regulatory requirement, what would be your guidance to the auditors on its applicability, or I would say more on the reporting? You can each share two important aspects which you feel as your guidance to the auditors on this new regulatory requirement.
I think this is a very, very unique guidance, the requirement which has come up globally. No other country, to my knowledge, has, this kind of a requirement at the moment. And, I think it's a huge responsibility as part of the auditors also to substantiate and say how the managements are, sort of complying to these requirements and etc. But what is more important is the benefits that you will get out of these, both from a management perspective as well as from an audit perspective. Because imagine the amount of data that is available, and if you start applying some of the new age solutions, like let's say Gen AI or bots or rule-based audits, because already there is a lot of discussion going on across the globe in terms of saying, is sample-based testing a right approach? I mean, I don't want to open a new Pandora's box here, but that is a fact where people are saying, can 100% audit be feasible, rather than a sample-based audit? So if we are moving at any point of time into that direction, such kind of data availability will be a huge step, as a first step at least, to enable some of those aspects that are being discussed in the profession. So I'll take a pause here, but happy to hear more thoughts from the other panelists as well.
Thank you, Kedar. It was wonderful having you in this panel, and we look forward for more interactions with you going forward. Deepaji, your closing guidance to the members.
Yeah. Thank you, Vishalji. And I think, it was a very interesting webinar, I would say. So one is, what you mentioned in the beginning, please read the guide, the FAQs, they're very comprehensive, based on your own queries, the members who are participating here. And I'm sure if we'll put up more queries, Vishal sir being part of AAS, we can take up more, right? So as you mentioned, we can have another webinar, we can have another FAQs, right? So more and more questions and learning, making sure that we do not have these challenges in the next year. And I think you are being very kind enough even to have that expert panel for the member queries, which done by AAS, which members can even send their queries to that expert panel. And the second thing I want to highlight is that be very upfront in your discussion with the management. If there is, it's not there, it's not there. It's a legal requirement, and we do not have a choice. It's a factual reporting. Please explain it to the in your discussion with your client. If you see even the language in the guide, and I'm taking this liberty here to point out that it says modify comment. So please note the word there. They're everywhere saying modify your comment when it comes to reporting 111G. So just be upfront about it, and there could be a limitation, probably which management can rectify later on. And use of an IT expert. I mean, wherever you feel it's required, use that expert, because there may be a situation with a complex issue, and you may want expert assistance to understand the management controls. Thank you.
Thank you, Deepaji. Always a pleasure having you on board in any of the technical sessions, and definitely as a very active contributor in the AASB and also on the implementation guide. In fact, you mentioned the same words that were in my mind about factual reporting. That and in fact, the implementation guides also, like Deepaji rightly mentioned, has these various situations. That if there are any non-compliances, then how the auditor can report. It does a lot of hand-holding. Thank you, Deepaji, for sparing your time and being with us. And last but not the least, our mentor, our guide, our past president, Manoj Fadnis sir. Sir, your guidance to our fellow members.
So thank you, Vishal bhai, and I fully concur with what was mentioned earlier by the two speakers, and I also had in mind to say the same, that first thing that a member should do is read the implementation guide. Once you read the implementation guide, I'm sure the majority of the doubts and queries get resolved. The way all aspects have been brought out, what is to be audited, how it is to be audited, how it is to be reported, and what is required and how it is required to be documented. I think most of the questions which were discussed, asked by the members during this webinar, I'm sure the members will find solutions and right answers, detailed answers, with all reasonings. And I must really compliment all the people who have been involved in preparing that technical guide, because every response is preceded by a detailed analysis. So as to what is the requirement under the rules, what is the auditing requirement under the different standards, and and correlating that, what is the procedure which the auditor should find. So my first very strong suggestion, recommendation is that members should read that implementation guide in detail. Having said that, there would be issues, there would be situations which would be beyond what is actually contemplated, because all situations cannot be brought in any publication. So there could be situations which would still be there. And in such scenarios, one has to really follow the standards, because they are principle-based standards. The standards don't give rule-based guidance with respect to every situation. So the principle-based standards need to be followed, and depending on the impact which it has on the financial statements, the factual reporting under 11G, and if reporting required under other different clauses as we discussed, should be carried out. But yes, if one is auditing an entity which has complex softwares and number of softwares being used, it is good to have a proper IT expert within the engagement team who could guide and help the audit team in coming to the right conclusions. So thank you very much, Vishal Bhai, for this opportunity. It's been wonderful participating and listening to the other co-speakers.
Thank you very much, sir. And it's always a delight to have you amongst us and to listen to you. Thanks to Aditya ji and Ashish ji for wonderfully moderating the session, and of course Nidhi ji. But I would now request Pramod bhai for his closing remarks and a vote of thanks. Over to you, sir.
Thank you, Vishal bhai. In fact, the session was very, very interesting, lively, and a lot of practical things discussed today. And thank you for making such a session a great learning for everyone. Because as already said, that this session would be made available is already there on the ICI TV. Anyone can see. Thank you, Past President Sir CA Manoj Padniji, for leading us and for always guiding us and taking this session in the very right direction. And of course, our two other panelists, Kedar ji and Deepa ji, for making an equal contribution and making the discussion so lively. And of course, for making that session lively, we have got the two very intelligent and smart moderators, CA Aditya ji and CA Ashish ji, for making the questions, asking and re-asking those questions. And of course, taking the lead is our Vishal Bhai, who is not only the convener of this Center for Audit Quality, but also the force behind the creation of that implementation guide for the audit trail, because he is the vice chair of the Auditing and Assurance Standard Board. And then thinking of this session, and of course, Nidhi ji for making this session applicable, effective. The only one point which is not there in the implementation guide and cannot be said, but I just want one point to all participants to take care that generally sometimes we have an habit of creating our UDINs a few days after the signing of the audit report. Say audit report is signed on 2nd September and we are generating the UDIN on say 6th or 7th, something like that. So what happens that when we are issuing our audit report on 2nd September, we are saying that the financial statements are in agreement with the books of accounts. And you should take care that it is not that after the 2nd September, the audit trail reflects that the entries were passed after 2nd September. The audit trail would be showing that.
Yes.
So though here the auditors have to be very, very careful that the UDIN is generated on the same date on which they are issuing their audit report. There should not be any delay. Audit trail would be the first effect would be there on the auditor. So they have to be very, very careful on that. With this note, I again thank each and everyone and all the participants for joining. Thank you everyone for the great show. Thank you very much.
Thank you everybody, and have a nice evening and a wonderful weekend.
Thank you.
Thank you, sir. Thank you. Thank you, Deepa ji.
Thank you. Thank you.
Thank you.
Ashish bhai, Aditya ji, thank you very much.
Thank you, sir.
Pramod bhai.
Thank you.
Thank you, sir.
Thank you.
Thank you, Nidhi.
Thank you.